7 golden financial advices from Warren Buffett that you must hear at least 8 times if you want to be rich. Have you ever sat in a Starbucks watching those 70-year-old men still looking sharp in their crisp suits, casually reading the Wall Street Journal, and wondered, why do they seem so worry-free about their 401k or Social Security while I'm constantly stressed about money? I used to have that same question until I discovered the story of a man named Warren Buffett, someone many called a master of wealth creation. I remember a story my grandfather told me about 2 farmers in Nebraska, Buffett's home state. The first farmer worked tirelessly all day growing corn, then sold everything to buy a new pickup truck and expensive lawn equipment to show off to neighbors. The second farmer also worked hard growing corn, but he always kept aside the best seeds and profits to buy more land for the next season. 10 years later, the first farmer was still struggling on the same small plot, while the second farmer owned hundreds of acres of farmland. Warren Buffett is the second farmer in this story. What's fascinating is that Warren Buffett, the world's 5th richest man with a fortune of over $100 billion, still lives in the same house he bought in 1958 for $31,500. He still drives his old Cadillac, eats breakfast with McDonald's hamburgers, and here's the strangest part. He's never carried a smartphone. They've been lying to us about what wealth really means, my friend. We've been taught that to succeed, you need to make lots of money, buy luxury cars, live in mansions, and fly first class. But truly wealthy people do the complete opposite. If you want to know how to build lasting wealth even when you're over 45, hit subscribe and comment Buffett Mindset below, because what I'm about to share could completely change how you think about money. Warren Buffett's first piece of advice sounds so simple, it's almost laughable. Never lose money. Rule number 2, never forget rule number 1. When I first heard this at a financial seminar in Chicago, I thought he was joking. But after thorough research, I realized this is the most profound financial philosophy I've ever encountered. Buffett isn't talking about avoiding risk, but about not gambling on things you don't understand. During the dot-com crisis of 2000, when all of Wall Street was rushing to buy tech stocks, Buffett was ridiculed as old school for refusing to participate. CNBC and Bloomberg all said he didn't understand the internet, but the truth was he understood the essence of investing perfectly. While the Nasdaq lost 78% of its value from its 2000 peak, Berkshire Hathaway continued to grow steadily. Before investing a single dollar, apply the 10-minute rule. Can you explain how this company makes money in 10 minutes to a 12-year-old? If not, don't invest. Start with what you know. If you work in healthcare, research pharmaceutical companies. If you're a teacher, look into education companies. Protecting capital is always more important than generating profits. Once you lose 50% of your capital, you need 100% growth just to break even, which is extremely difficult. This leads me to the second piece of advice, something I had to experience personally to understand. Be greedy when others are fearful, and fearful when others are greedy. Sounds contradictory to human nature, doesn't it? But this is the secret to creating real wealth. I remember in 2008, when Lehman Brothers collapsed and all of Wall Street was shaking, I panicked like everyone else and sold off my entire 401k at rock bottom prices, losing nearly 40% of its value. Meanwhile, Warren Buffett invested $5 billion in Goldman Sachs right in the middle of the storm. CNN and Fox News wrote that he was betting wrong. But just a few years later, this investment generated $3.7 billion in profits. That's when I realized that the greatest opportunities often appear when people are most panicked. Create a war chest, an emergency fund equal to 20% of your total investment portfolio to be ready to act when markets crash. Also, set up an automatic investment system, dollar cost averaging, to buy consistently regardless of whether markets go up or down. When everyone else is selling, this system will automatically buy at low prices. There's a story Benjamin Franklin told about a wise merchant in Philadelphia during colonial times. When everyone in town wanted to sell wheat because they feared a British boycott, he quietly bought all at low prices and stored it in warehouses. When war broke out and wheat became scarce, he sold it and made 10 times his investment. Warren Buffett is that merchant in the modern world. The stock market is a machine that transfers money from the impatient to the patient. Learn to love those red-hot days. Are you finding this helpful? Comment, got it, if you want to continue exploring the remaining 4 pieces of advice, because what I'm about to share will completely change how you view investing. The 3rd piece of advice changed my life. Invest in what you understand. Warren Buffett never bought Apple stock until 2016, despite Apple's success for many years before that. It wasn't because he didn't like technology, but because he waited until he fully understood Apple's business model. From creating a closed ecosystem to building customer loyalty like a luxury brand in technology. I have a friend named Mike who worked for Walmart Logistics for over 20 years. Instead of chasing hot stocks like GameStop or AMC that Reddit was pumping, he only invested in retail and logistics companies he understood deeply, from supply chain to customer behavior. He knew exactly why Target succeeded in suburban markets, why Costco had such high customer loyalty. The result? His investment portfolio grew steadily at 12% annually for 15 years. While many others lost heavily due to FOMO into meme stocks they didn't understand. Apply your circle of competence. Draw a circle around the industries and products you truly understand. Within that circle, you can invest actively. Outside that circle, stick to index funds. Don't expand this circle unless you spend at least 100 hours researching a new field. Knowing your limitations is a form of intelligence. In the investment world, arrogance is the fastest path to failure. This brings me to the 4th piece of advice, something age has taught me. Time is a friend of good investments and the enemy of bad investments. Buffett often says his favorite holding period is forever. He bought Coca-Cola in 1988 and still holds it today, 35 years later, with returns of over 20 times his initial investment. Establish a buy and hold strategy with a timeline of at least 10 to 15 years. Open a Roth IRA if you qualify, or maximize your 401k company match. Don't check your portfolio daily. Research shows investors who check portfolios frequently underperform by 2 to 3% compared to those who check quarterly. There's a story John D. Rockefeller told about his father in upstate New York. Instead of buying small plots for quick business, his father bought large plots on the outskirts of the city and patiently waited. 20 years later, when the city expanded, those plots became prime real estate. Time and patience, Rockefeller said, are the 2 most powerful weapons of wealth builders. Compound interest is what Einstein called the 8th wonder of the world. Those who understand it earn from it. Those who don't pay for it. The 5th piece of advice saved me from many wrong decisions. Price is what you pay. Value is what you get. Many people buy stocks because prices are rising, but Buffett buys because he believes the intrinsic value of the company is much higher than the current market cap. I made this mistake in 2006 when I bought a townhouse in Phoenix because prices were hot, rising 20% annually, without considering that the area was too far from downtown, had no public transportation, and no shopping centers. The result was when the housing bubble burst in 2008, I had to do a short sale with a $120,000 loss. Meanwhile, my cousin David bought an old ranch house in Scottsdale near a good school district, even though the price was slightly higher than comparable homes at the time. 15 years later, David's house increased in value by 2.5 times. Learn to calculate PE ratios, PEG ratios, and especially price to book value. Don't buy stocks just because they're rising. Research the fundamentals. Use the DCF, discounted cash flow, method to estimate intrinsic value, or at least compare with industry average ratios. In the short term, the stock market is a popularity voting machine. In the long term, it's a value weighing machine. The 6th piece of advice seems contradictory to what Buffett usually does. Diversification is protection against ignorance. It makes little sense if you know what you are doing. Buffett concentrates his investments in a few companies he understands very well. 80% of his wealth comes from just 10 investments, rather than spreading across hundreds of stocks. But for beginners or those without experience, diversification is a way to protect yourself. If you don't have 10 plus years of investment experience, use the core satellite strategy. 70% in diversified index funds, S&P 500, total stock market, 20% in international funds, 10% experimenting with individual stocks you researched thoroughly. As experience grows, you can increase the satellite portion. Warren Buffett once told a story about his grandfather in Nebraska during the Great Depression. Instead of putting all his money in one local bank, he divided it among 3 different banks in 3 different towns. When one bank collapsed, he still had money in the other 2 banks to maintain farm operations. But Buffett added, when my grandfather became an expert in the banking industry after many years, he only put money in the bank he trusted most. Diversification is insurance against ignorance. When you understand a game, you can make concentrated bets. But be honest about your level of expertise. And finally, the 7th piece of advice might turn everything you believe about success upside down. Success in investing doesn't correlate with IQ. Once you have ordinary intelligence, what you need is temperament and discipline to control the emotions that drive most people's investment actions. Buffett once said he knows Harvard MBAs with IQs of 160 who fail miserably at investing, while farmers in Iowa with high school educations are extremely successful. Why? Because smart people are often overconfident and make complex decisions, while more humble people stick to simple, effective principles. I once met a software engineer in Silicon Valley with a PhD from Stanford, very intelligent, but he constantly day traded, seeking alpha through algorithmic trading and complex option strategies. He thought he could outsmart the market. The result, after 5 years, he lost 60% of his portfolio. Meanwhile, a plumber in the same neighborhood consistently invested in Vanguard S&P 500 index funds every month, ignoring market volatility and financial news. 10 years later, the plumber had a retirement fund 4 times larger than the engineer's. Establish an investment policy statement, a document outlining your philosophy, goals, and rules. When emotions run high, refer back to this document. Also, limit portfolio checking. Research shows the optimal frequency is quarterly, not daily. IQ gets you to the game, but EQ wins the game. Emotional intelligence in investing is the ability to control fear and greed. Is this worth trading $500,000 in a single day? The answer lies in your own hands. Now you know the 7 golden principles that Warren Buffett has applied for 70 years to build his $100 billion fortune. These simple habits can completely change your financial future, regardless of your age. If just one of these pieces of advice makes you reconsider how you manage money, promise yourself you'll apply it this very week. Comment Buffett Mindset if you're ready to start building real wealth instead of just looking for quick money. And don't forget to hit subscribe and ring the notification bell so you won't miss more helpful financial videos. I'll be sharing more specific strategies from other billionaires like Charlie Munger and Ray Dalio. If you want to analyze more deeply how to apply these principles to your specific situation, leave a comment and let me know. Age is just a number. Financial wisdom can be learned at any age. As Warren Buffett often says, the best time to plant a tree was 20 years ago. The second best time is today. Start today. Your wealthy future is waiting.